Welcome back to the Avenue. I'm Adrian and thank you for being here. We've crossed over to another year and it's going to be a great one. And in the spirit of making this our best year, 2026, we want to venture out and talk about some topics that we didn't talk about last year. And those topics have to do with the credit score. And credit scoring is very important because it will help you get the best rates out there. And as companies are looking at how you utilize your credit, it can get you even better rates. Just recently I got a letter in the mail from my insurance company that said that they ran my credit score. And this is just a normal part of the insurance company doing this. This is my first time getting this, and I've been with the company for a long, long time. So people are checking credit scores. It's vital that we keep ours in order and that you know what yours is, how to get it, and that type of thing. So we're going to jump right into it next.
She's a go-getter, alright. What a beautiful sight. Anything she sets her mind to, she stays on it day and night. She writes the checks, she signs the deeds. She plants the fruitful seeds and still finds the time to meet all her family needs.
And what's all this talk about the credit score? It's very important. Everyone has one. And what it is, especially if you use credit, it is a 3-digit number that helps lenders think about and know your credit worthiness. Just think, if you were a lender, you would want to know how likely you are, or someone who wants to come borrow money from you, to pay off that money. How likely are they to do that? This score will let them know exactly that. It looks at your past record of what you've been doing with your credit. Have you been paying? Have you been paying on time? What are the things you've been doing? And if you put yourself in that lender's shoes, are you a good risk? Are you an okay risk? Or do you just not want to lend to that person because of their past history as far as what they've been doing, as far as paying back loans and what they've been doing with their credit? This is vitally important. And if we think of it like this, putting yourself in the lender's place, it's not hard to realize and recognize why they do these things. And this is like I said, a 3-digit number out there, and it ranges from 300 to 850. And so the higher up you are, when you start getting to the 800s, 850, that's a great credit score, and you can pretty much get the best rates that are out there. So we're going to jump right in because I want you to have the highest credit score possible. So that's what's up next. We're going to go over some of the components that make up your credit score. I'm going to tell you how to get your credit score, how to get your annual report for free, and that's what we're going to talk about on the show today. There are 5 factors that make up the components of calculating your credit score, and that is the very first one, and the biggest one is your payment history, and that is 35% of your credit score. So if you want to move your credit score in any way, this is the one thing that you want to look at for sure, because it makes up 35%. It makes up the largest percentage. What is payment history? It's how you've been paying your bills. Have you been paying on time? Have you been late? Do you have any over 30 days, over 60 days, over 90 days? Are you delinquent somewhere? Do you have any bankruptcies? This all adds up to the 35% that they look at in your credit score. Now, let me just say this up front too. You have many credit scores. It's not just one. You have many credit scores out there, and they are used differently depending on if you're going to buy a house, if you're going to buy a car, if you're going to get insurance. They all use different credit scores, and so we'll get a little more into that. But the 35% is the largest amount that makes up your credit score. So you want to make sure you're paying on time every time, and your payments are not late. Now, distinguish the difference between they start recording when it is 30 days late. So if you miss a payment and in 15 days, they said if you miss it and don't pay it in 15 days, you owe this. As long as you pay that, it will not be recorded on your credit history report, right? So because you're not 30 days late, they start at 30 days late. So even if you're a few days late, or if you're 10 days late and they say 15 days late, whatever it is, and they say if you don't send it in to us by this time, you will need to pay an extra amount, the late fee, the late charge. Go ahead and do that to keep it off of your history. You don't want that on your credit history. So do that and you won't be considered late according to the credit score. Just a tip. The next factor is your credit utilization. What does that mean is how much of your credit are you using? And a good rule of thumb that I've researched and it's out there is that 30%, you want to keep your credit utilization down below 30%. And what I mean by that is, like, if you have $1,000 of your credit limit, this is how much you can borrow. 30% of 1,000 is $300. So you don't want to go over that, because when you start going over the 300, then it starts affecting your credit score and your credit score starts dropping because you're over a certain amount. And this all makes sense, because if you want to lend to someone and they're stretched out as far as if they have some credit out there and they're almost maxed out of their credit, do you really want to lend to them? Because if they're maxed out there, they get maxed out on yours, who are they not going to pay? Who are they going to cut off? What's going to happen? Are they going to be skipping payments here and there? They're going to be asking for extensions. You just don't know what's going to happen. So the higher they are up in that utilization, it reflects on, do I really want to lend to this person? So the lower down you can be, the better off you be. Me personally, I don't go by the 30%, I go by 10%. I try to keep my credit cards, up under that 10%, because even though I do not pay interest on my credit cards, they run my credit score, or if I go out somewhere, my credit score will be run, right? And whatever it is, when the credit score is run during that time of the month, that's what they're going to calculate it at. So I want to make sure it's below, for me, 10%. So I'll look at it as much as I need to. If I know I'm charging, I know what my max is. So I know when I start creeping up to that 10%, and I'll go in and just pay a certain amount on it to keep it below that 10%, because I'm going to pay it off at the end of the month anyway. So this is not, I'm taking extra money from somewhere else just to pay it off. It's going to be the money I'm going to use at the end of the month to pay it off anyway. So keep that credit utilization as low as possible, because it makes up 30% of the factors that add into your credit score. Next up, we have the length of your credit history. So the length of how long you've had these certain accounts means a lot, because the longer you've had an account, it shows your record over and over of making payments. Have you been making payments on time for the last 3 years, 4 years, 5 years? Do you have any late pays on there at all? That will work in your benefit the longer you have them. Now, if you have a credit card, I have two. One I use all the time. The other one I use off and on. Don't use it all the time, but I will not shut that one down because I've had it a long time. It shows that when I did have it, when I am using it, I pay like it should be. I don't miss a payment, right? And on the one that I use every month, of course, I don't miss a payment on that. If your mortgages are out there and you shut down a mortgage to buy another house, you're opening up another line of credit, that will affect your credit score. It'll rocket for a couple of months and then it'll, be fine. But the longer you have these long accounts, even if you don't use it, even if you shut down and say, like, I'm not charging on this credit card again, just still let it stay open, because you have a history of paying it on time. So you want that to count in your favor. So that does affect your credit, is how long you've had these accounts. And that affects your credit. That's a 15% amount that it affects your credit. So we've got 35%, 30%, and now this is 15% that it'll affect your credit score. That's the percentage, 15% that it'll affect your credit score as far as how long you've had these accounts open. Next up at 10% is the mixture of the kind of credits that you have. These scores, these credit scores, like for you to have a mixture. They want to know that you're responsible, whether it's a revolving account, you're responsible, whether it's installment payments. So if you have credit cards, if you have store cards, if you have mortgages, if you have car loans, All of that mix is helpful to you. Now, me, I don't. I have mortgages and then I have the credit cards that I use. I don't have car loans and all this other stuff, and it has not negatively affected my credit score simply because I have a history of paying things on time, and the mixture is enough right now. I'm sure I could probably get it higher. I don't have it at 850, and that's probably one of the reasons I don't have it at 850, because I don't have all this credit out there that to prove that I have a large mixture of credit out there. So but I'm not worried about that. I'm above 800 and I'm just fine because I can get the best rates out there. You do not have to be at 850, by the way, to get the very best rates. Once you start getting into the high sevens, and I won't say exactly what it is because it kind of changes, but if you get into the high sevens, 800s, you will get the best rate that's out there because you have excellent credit at that point in time. So, but this is 10% of the credit mixture, is 10% of what counts towards your credit score. And that's what these credit scoring systems, that's what they're looking for, a mixture of credit. And last but not least, 10% goes to the new credit that's coming in. If you apply for a new card, it's going to hit your credit as 10%. They look for that. Now, as the applications get older, like they start falling off, I think at 2 years, if you apply for something, it's going to be on there. It's kind of ding you a little bit. If you have more than 2, normally that's going to affect your credit score. It's going to drop it because it shows that you're going out and applying for new credit here, new credit there. And anytime this credit scoring system is activated or alerted or awakened because of something that you've done, it's going to say, let me recalculate this to see if we need to go up or down on this person, because, why would you be going out getting all these random credit cards? So that will affect your credit score. So you only get the new credit if you just have to have it. But if you go to one of these places, store cards or furniture stores, that they're going to run your credit to open up an account, they're going to pull your credit. So it's going to be a hit on you. And that's called a hard credit hit. And so there are soft credit hits where, like utilities that you may get, and they say, well, we need to run your credit to see if you're going to have a deposit for opening up a utility if you move from one house to another house or anything like that. And those are usually soft credit. But the hard credits, those hits, those are the ones that count. Those are the ones that hurt when they pull a credit report on you, and it's a hard pull. Then it's going to affect your credit score, or it could affect your credit score. So let's be careful with opening up a lot of extra credit accounts, or, when you go shopping and they say, well, do you want a card from here? If you say yes, they're going to run your credit and it's going to affect your credit score. So if you don't have to have a card from there, even if they say, you can get this card, we can get it to you right quick, right now, and you'll save 25%, and you can always pay off what you just charged. I don't go for any of that. I don't fall for it. I don't need any more cards, and that's what I tell them. I don't need any more cards, and that's what we roll with. So just be careful about that, because the salespeople are out there. They're doing their job, enticing you to get credit with that score, because they know once you get a credit card, it's going to be so easy if you walk into that store and you don't have the cash to go ahead and use their credit card. Now, at this point, I want you to use your credit or not use your credit, but hit that like button and that subscribe button so that you can stay up to date on the latest information as I'm bringing it to you. Credit is so important, you guys. It's vital. I know some people don't believe in credit cards and having credit, but when you need it, that's when you'll start to believe in it. You can still pay your bills on time, but have good credit, because it's going to help you in the long run if you ever need the credit, or if you're applying for something and they need to run your credit score and it's there and it's good, then it would be to your benefit to have that credit score. So let's not sleep on this. The big question is, how do I improve my credit score? Well, the best way to do it is to really talk with a lender or professional that can help you, actually give you some tips on what you need to pay off, what you need to pay on, what you need to do to improve it, because you can improve your credit score depending on what it is. You can improve it in 6 months, you can improve it in a year, depending on what's on there. So it's not like a hopeless case. But that's something that from year to year, I know a lot of people, I want to start working on it. I want to start working on it, and they never get around to it because it's a discipline thing. It's something that you have to choose that this is what I'm going to do and go for doing exactly what you say you're going to do. Of course, making those payments every month on time without being late is the biggest way to improve your credit score. Keeping your utilization down, paying down those credit cards below the 30%, or my goal is below the 10%. Even if you have, two credit cards out there and you want to keep them, if they're at $1,000 a piece and you want to keep it below the 30%, you cannot have more than 300 on each one of those, right? Or if you have 600 on one, you need to have that other one at zero. So it's the amount of total credit you have out there and what percentage do you have on that. Now, mortgages, that doesn't count because that's a different thing. They know exactly. And there's another way of figuring mortgages as far as if someone wants to lend to you to get a house. And we'll cover a little bit of that a little later on. But making the payments on time, critical. Keeping your credit utilization as low as possible on these credit cards, that's also critical. Having that mixture has a lot to do with it. But if you do those two main things that affect the largest percentage of what they're looking at on your credit report, you can help yourself a whole lot just by doing those simple things. Anything else as far as looking at your credit report, if there are discrepancies on there, you need to get those off. If this doesn't belong to you, you need to get those off. And there are credit people out there that can help you do that. Or you can do your own research because it may be as simple as writing a letter to the person that said that you had it on there, and either making them prove that it's yours or getting it cleared through whatever company they said that it's with and getting it taken off. So there are ways to get your credit under control so that you can have a better credit score and you can have, buy the things you want to buy without paying that high interest. Now, for a brief moment, let's talk about your FICO scoring range. FICO means Fair Isaac Company, and this is this company that that came up with the scoring models as far as developing how can we judge people as far as their credit worthiness. And the first range that I'll talk about is from 300 to 579. That's a very poor score for obtaining a credit card or a loan. Is very poor. A fair score is from 580 to 669. Lenders consider this a fair score, but it's still a slightly higher risk. A good score is from 670 to 739. And this score in this range is much more appealing, and you can probably get the loans and credit cards, but it's considered good. Very good is from 740 to 799 points. And this score is a range that are above average, these scores. And the exceptional score, of course, is from 800 to 850. That's an excellent score, and you can pretty much get the best interest rate out there and the best credit that you have. And so a lot of people shoot for the 800. Sometimes you don't need to be in the 800s. You need to be in the high 700s to get the best rate, but shooting for an 800 is a great thing to do. Now, there are 3 companies that will give you your credit score if you've tried to get it lately and give you your credit report. That's Experian, TransUnion, and Equifax. Those are the 3 companies that will issue your credit score. You will notice that your credit score will be different for each company. Why is that? Because these companies use a different FICO scoring models to give you the score. Whatever they emphasize with that company, that's what they're going to run on you. Some emphasize late payments more. Some emphasize, how long you've had the credit more. But whatever it is, that's what they're going to use on you. Normally, when you get a mortgage, though, they will run the 3 credit scoring from those 3 companies, and the middle one is the one that they will take. If it's you and your husband getting the loan, they will run them on both of you, and the middle one is the one that they will take on you. Whichever one is the lowest middle one, that's the one that they're going to take, because that is the most risk that they want to take or consider when getting a mortgage loan. Another thing you need to know is that a mortgage loan's credit scoring models is different than buying a car. You can go out and buy a car in most cases with a poor credit score, but when it comes to a house, more than likely you're not going to be able to buy a house with a poor credit score. Also, if you get these credit cards, they will let you have a poor credit score and get a credit card because of the different scoring models. In the insurance industry, they use even a different scoring model because they want to know, they don't necessarily care about your income and that type of thing. They want to know if you're, paying late, and they just have a different way of looking at credit. But there are a lot of models out there, and you have a profile for all of them. They can pull whatever they want on you if you've been using, credit and you have this to pull on you. Some people don't use credit and they don't have a score. So they have to go through a manual process in order to get some of these products, whether it's a car, whether it's a home, whatever it is. If you have a zero score, they'll have to go through a different way of doing that. And more than likely, the amount that you're going to be paying is probably going to be, don't quote me on this, but I've heard that it's slightly higher because they cannot pull that. And even if they go through a manual like underwriting on you, it's still going to be a little bit higher because they have no record of certain things as far as how your payment is going, just to compare it with everybody else, right? So just keep that in mind. And that's why I'm more in favor of having a credit score than to not have a credit score or have a zero credit score and not have any credit. I just would rather, if I needed something, I would rather be able to use it and have it. I'd rather have it than need it and not have it. I'll put it like that. So just keep that in mind. One more little note, if you're using the credit score off of some of these free places where you can get like Credit Karma, places like that, or even sometimes your credit unions or banks will send you your free credit score. Be careful with that because I know the Credit Karma stuff, they use a different scoring model, and when you pull your true credit score, it's more than likely going to be different. And Credit Karma, sometimes that credit score is higher than what is pulled, when you pull the true one with one of the three companies. So just be aware of that. If you use Credit Karma or some of these places that say we'll give you a free credit score, I would not 100% depend on that. If you want to get your credit score, you can get your credit score. There are places you can pay and get it. If you want to get your credit report, which is probably as equally important as a credit score, because a credit report will tell you what your payment history is, how many open lines of credit you have out there, how many closed lines of credit you have out there, who's been pulling your credit or how long, what companies have been pulling your credit, that type of thing. You'll have all of that, and you can get that for free at annualcreditreport.com. You can get that once a year for free. Now, when the pandemic was going on, you could get it every month, as a matter of fact, for free, so you can monitor it. I would say at least get it once a year for free. It will give you all three of those companies, the credit score on all three of the companies that we talked about. And so what you could do if you wanted to, when you go in and order it, you can order the first 3 months on the first company, Experian, Equifax, or TransUnion, whichever one you want to use. Wait 3 months, order the second one on the next one, wait 3 months, order the third one on the next one. That way, as your credit is changing over the year, you can see what's on there on the report, if something is on there, and get this report and look at it. It'll have your old addresses on it and everything. If something is wrong with these reports, you need to go in and get that fixed, because that's what these other places are pulling. And if it's wrong for you, it's going to be wrong for them, and it may affect your credit in a negative way. So go out there to make sure your credit is. I have pulled my credit. It's been over 20 years, and something from my sister's charge that I've never authorized, never signed anything that or credit card was on my record, right? So we had to go in and get that straightened out, and they took it off because it was their error. Whoever put it on my record should not have been on my record, should have been on hers. But it was bringing my credit score down, and so it's good to check just to make sure what you have on yours is accurate, and you know what they're saying that you're paying, how you're paying, and whatever accounts you have open, all that is accurate. That's what you want to do, because you can raise your credit score just by getting things in error off of your credit report. Hopefully, we've talked about the things that you want to know about your credit score, your credit report, and you can go out and make sure you're good financially here. It's good to be financially good in the other things that we've talked about, as far as savings accounts and emergency funds and investments. But to have a solid foundation, you need to make sure your credit score is good also. We want to be all around good with our credit. We want to be all around good with our finances. And so this is a great way to start, to make sure everything is cool, everything is okay for the new year. So if something comes up, an opportunity that you want to, buy or get a loan for, it could be a business, it could be anything, but it's an opportunity for you. You don't want to be hindered by, well, my credit score is not good, I got to clean it up and that type of thing. If you know that your credit, if you know you haven't been paying your bills on time, you already know your credit score is not good. So let's jump on the bandwagon. Let's clean up what really is our responsibility. Anything that's not supposed to be on us, let's get it taken off. But if you know that you made that bill and you didn't pay it on time or whatever it was, and the further out you guys, the earlier, the late pays that are like 30 days right now, that's going to hurt you the most, because it's showing right now you're having a problem. Or if there's a pattern of every December, they have a late pay. Well, that's going to be a problem because it's showing a pattern. But if you get out of that, start paying everything on time, and do not charge if you cannot pay it on time. Okay? It makes sense. If you can't pay it on time, don't put it on the credit card. You can't afford it. So just don't put it on the credit card. Do yourself a favor. But let's get our credit score in order. Let's get our credit reports in order. And if you have any questions, just put them in the chat below, and I'll do my best to answer them for you. Okay, especially if there's mortgage questions on, getting your credit score and all that together. I'd love to try to address some of those issues. Okay, so with that, I will see you in the next video.
Go Adrian. Humble, go get a bless. Let's go.